Okay, so we'll be looking at the cash flow statement, IAS 7, under financial reporting. When financial accounts, just know that this is cash flow statements. So in cash flow, when calculating anything that has to do with the cash flow, you know that one, this is the indirect method. So we have the operating activities, and you see how we'll be calculating everything under operating activities. Then we have investing activities, and we also have financing activities. So we'll be calculating these kinds. Okay, so now before you do anything under the cash flow, the only thing that you should check for are the following. You have to calculate your cash and cash equivalent. You have to calculate your cash and cash equivalent. So you must know your opening balance. Okay, so you have to know your opening balance and your closing balance and your movement. Okay, you have to know these things. So in this question, you didn't have because initially your cash and cash equivalent should consist of cash and bank, should also consist of treasury bills, short-term investments, and bank overdraft. And where you can find these things in this question, you have to check under this part. You must find short-term investment, bank and cash, treasury bills. And in this case, I can only see bank and cash. Let's enter that. Now, if you check on the dates again, let me just use a better color. If you check on the dates, this is 2015 and this is 2016. So these are your opening balances and these are your closing balances. So we're going to get this amount as our opening balance. Okay. So our opening balance was 2350. Okay. So opening balance was 2350 and our closing was 2160. If not mistaken, let me just check that again. Yeah, 2160. And where are you going to check for bank overdrafts? This part. And in this question, we didn't have bank overdraft. So what we're going to do is just check on the movement of cash and bank. So the movement means, if you check into this question, you find out that from your opening to your closing, there was a decrease in cash. So because there was a decrease in cash, and I'm sure your decrease must be something like 2350 minus 2160. The decrease, okay, 2350 minus 2160, the decrease should be negative 190. Why negative 190? That's why I'm putting it in brackets, because your opening balance was 2350, then your closing balance is 2160, which means you had removed some of the cash from your bank. So because there was a movement from a bigger value to a lower value, there was a decrease. So any decrease in cash and cash equivalent becomes a negative figure. So this is your balancing figure when you're calculating. Now the next thing that you should do when calculating anything in cash flow, look at the information given. The first information says during the year ended 30 June 2016, non-current assets which had costs 230 were sold for 145,000. The loss on this disposal has been included in the trading expense in the statement of profit or loss. So let's start with this part. We are saying this non-current asset which cost 230,000 was sold. Now, what you have to do when they talk about a non-current asset, okay, if you check into this question, there's this part. It also talks about the non-current assets. We've said these are your opening balance and this is your closing balance. What was our opening balance on non-current assets? It was 3,000 and our closing was 3,500. So which means in as much as we, because there's an increase here, so in as much as we sold an asset, those a non-current asset, the other name for non-current asset is fixed asset. So there's a fixed asset that we actually bought, but then we cannot just find the difference and say this is the asset that we bought. We have to calculate. So you have to make a non-current asset account. So you have to make that account, non-current asset account. So a non-current or fixed asset account has a debit balance. So you have to write balance brought forward and check. And in the question we had 3,000 as our balance brought forward. Let me just show you that again. This was our balance carried brought forward, because this is the previous year and this is the our current year. So, and our balance carried down was 3,500. So this 3,500 was actually the balance for the year, and we're going to write it as carried down 3,500. And there, brought down is still 3,500. Now, the other thing you must check for in the question is revaluation. Is there any, and this revaluation you can find it where it is written capital and reserves or equity. They can use either of the words. And in this question we didn't have revaluation, so we're going to leave it. Let's go back to an additional information. A non-current asset which had cost 230,000 was sold. So these zeros we're going to do away with them, because even in the question, if you check very well, they did remove the zeros. So we're going to remove the zeros and we're going to record 230. Now we sold this asset. Because we sold this asset, we're going to write dispose on the credit side to show that we've sold this asset at 230. So now this, you find out this side is the biggest, so we're going to write 3730 and 3730, and you find out that the difference when you subtract 3,000 from 3730, we have 730 as our cash. This is the amount that we bought an asset at, so we're going to have this amount reflecting in our cash flow. Let's take note of that. What else took place in our additional information? We sold an asset for 145,000, and they are saying this asset we sold it on a loss, and they're saying this loss is included in the trading expense. Now remember that the trading expense will be found in our profit or loss account. So this trading expense here, now they're saying this loss is found in this trading expense. Remember, a loss is an expense. But then this 475 is not a loss on disposal. We have to calculate the loss on disposal. How are we going to calculate the loss on disposal? We have to make an accumulated depreciation account. So we must make an accumulated dip account. So this account has a credit balance. What are you going to put there? You have to check in your question again. Okay, so in your question you find out that you have accumulated depreciation, and these are your figures for accumulated. This is your opening balance, this is your closing balance. So where we've written balance brought forward, we're going to put 2,100, and where there is a closing balance, we're going to put 23. So this is what happened. We have our 2,100 and I carried down 2,300. Okay, let me just repeat that. 2,300, and we have our totals there, and the balance brought down is 2300. So let's now check what happened. When you're making an accumulated depreciation account, you must also take note of depreciation. Now, depreciation is an expense, and when they tell you that depreciation, just know that they debited profit or loss and credited your accumulated depreciation. So we're going to credit 255 in your accumulated depreciation account. So 255 as depreciation, deep. What else should you look for in this question? In this adjustment, you find out that they didn't give you an accumulated depreciation for this asset that was sold. Quite alright. So the purpose of us making this accumulated depreciation is to find the missing figure, okay, that this asset that we sold was carrying, the accumulated depreciation that this asset that we sold was carrying. And if you add this part, you have 2355. So meaning the difference between 2300 and 2355 was 55, and this was the accumulated depreciation that was missing for that asset. Now, after finding that, you must calculate your disposal. We want to know the loss that we incurred after selling off. Now, remember that in your disposal account, there are only three things that enter your disposal: the cost that you sold this asset at, the cost at which you bought this asset at first, and we in the question, under additional information, it said this asset was costing 230. So you put the 230 there. Then we've said there are three things. Amongst these three things that we're going to indicate or record in our disposal account, only cost is debited. We had calculated our accumulated depreciation, which was 55 earlier, if you rewind the video, and the cash at which you sold it at, and we are saying you sold this asset at how much? 145,000. So 145,000 was the amount that you sold this asset at. 145,000. Now the rule is that if and only if the costs of this asset that you sold is lesser than this side, which is when you add the accumulated depreciation and the cash that you sold it at, then you've made a profit. Now the question, if you check in the question they've said that we already made a loss, so they already know that we made a loss. So a loss is always on the credit side of the disposal account. So 55 plus 145 is 200, so which means we made a loss of 30. This account must always balance, so you must find the difference and close this account. The reason why we close this account is because we've sold this asset. So since we've closed this asset, we cannot find another disposal for the next year because this asset is no longer in our business. So we have 230, so we have the loss. So we're going to take note of that as well. Okay. Then what else happens? Now you have to check for another thing, taxation. Where can you find taxation or tax payable? Here, we don't have taxation. And also they would add taxation under your assets. We don't have taxation there. What else should you check for? Interest. Is there interest in this question? There's no interest in this question, so we can now start calculating our cash flow.